Hello friends, welcome to CEC live lectures. Myself Aditya P. Tripathi, Assistant Professor, Department of Commerce, Shamlal College Evening, University of Delhi. I am here with you to continue our discussion on the topic of marginal costing, which is one of the very important topic in the field of management accounting. We'll actually be talking about the introduction to marginal costing along with the PV ratio. Before I go through the lecture, I start my lecture, let me tell you what is our agenda for today's lecture. I'll first be telling you about what exactly we mean by marginal costing. Then we'll talk about ascertainment of cost under marginal costing technique. After that, we'll talk about income determination under marginal costing. What is the format for that? The way we actually prepare the income statement to determine, to ascertain the income and the cost and the profit under the marginal costing. I'll also tell you about the marginal costing for decision making. Why it is so important for decision making, whether it is relevant for short-term decision making or it is relevant for long-term decision making. That's what I'll be telling you in today's lecture, and after that we'll talk about cost volume profit analysis, which is also known as CVP analysis. So in different universities we have different nomenclature assigned for this topic. Somewhere it is said CVP analysis, somebody says it is break-even analysis, somebody says it is decision making, somebody says it is marginal costing. But we need to understand on the whole what exactly we have to do in this topic, and that's what I'm going to clarify today. So before I start about this marginal costing, its meaning and all, let me tell you what exactly we have to do in this particular technique, and why this tool is so important, why most of the management accountants, they are relying on this tool in the field of management accounting. Because as we all understand that managers have to take decision. It is basically a tool for decision making. Now the question comes, managers have to decide, so they need to have a quantified logic for giving their decision. They can't give a decision in a hurry or in a hurried manner, or just like that I am saying that this decision has to be taken. Every decision which we are going to make in our business enterprise, that need to be supported by some quantified logic. And for that, in that series, we have this chapter called marginal costing, this tool called marginal costing as a technique. Now the question comes whether it's a long-term decision making technique or short-term decision making technique. So let me clarify, it's a short-term decision making technique. Now the second question comes, my students are asking me, sir, why do we call it a short-term decision making technique? Why not long-term? Because whatever assumptions we have for marginal costing, that can only hold true in case of short-term. In long run, that cannot happen. That is why we have to rely on, we have to call it as a short-term decision making technique. When I'll be telling you about the assumptions like selling price per unit is constant, variable cost per unit is constant, and fixed cost in total it is constant. So these things are constant, or you can say they remain unchanged only in case of short run. In long run, we all understand there is nothing like fixed and variable cost. All cost become actually variable. So there is no classification of fixed and variable cost in long run, and that is what is the reason why we can't call this strategy, this tool, to be a technique for long-term decision making. This is actually a short-term decision making technique. So to be very clear, to be very precise, that whether marginal costing is a short-term decision making technique or it's a long-term decision making technique, we should not have any doubt. We should be very clear that yes, it is a short-term decision making technique which is actually used by the management accountants. Now the moment this term marginal cost comes, or you can say the moment this word marginal comes, we have a very basic idea about this term marginal. We are already familiar, because whenever we are going for studying the subject of economics, we are always taught about marginal cost, marginal revenue. Then we talk about MR and MC in our equilibrium, cost, revenue and equilibrium analysis. The same term marginal is also being used in the field of accounting. But there is a slight change into our interpretation, but the term marginal remains the same. Some people say that, sir, marginal, do you mean to say the last person in the line? Because in most of the political debates it is being said that marginal, there is a marginal person. This is for poor and marginal people. Marginal person who is at the end of the queue, the person who is standing at the end of the queue, that is called marginal person. Obviously that's not our case. Our interpretation for marginal cost will be that, suppose we are talking about rate of change into our total cost. So marginal cost means variable cost. So there is one assertion, there is one statement which says that marginal cost means variable cost. So any cost which is variable in nature, that can be called as marginal cost, because then only it is going to make change into your total cost. Your total cost will not change unless there is a change into your variable. There is a cost which is changing. Suppose if I talk about the factory, of any factory where you have installed a particular plant, and that cost of plant remains constant, whether you manufacture 2000 units or you are manufacturing 10,000 units. So within the capacity of the plant, whatever you are doing, that is not, whatever you are manufacturing, that quantum is not going to affect your total cost. So obviously the fixed cost cannot be called as marginal cost. So marginal cost means variable cost. This is one assertion, this is one statement which is given in most of the textbook and in most of the texts which are available for management accounting as far as marginal costing is concerned. We say marginal cost means variable cost. So any cost which changes with the change in production, that is called variable cost, and all variable cost for this matter, you can say they are actually marginal cost. Another definition, another statement which comes in front of us for marginal cost is the cost which tend to vary in direct proportion to the changes in the production level. So if you are changing your level of production and a particular or specific cost changes in direct proportion to that change in production, that is called, that may also be called as variable cost or marginal cost. So if you are increasing your production by 10,000 units and your cost is also changing in the same proportion, say for instance I am talking about cost of material, or if I talk about labor. So whatever change, whatever proportion, in whatever proportion you are changing your production, in the same proportion your cost is going to change. So we have to keep this thing in mind, that if my cost is changing in direct proportion to the change in the level of production, then we should rest assured that this is nothing but my variable cost. And this variable cost, we all understand, it is actually your marginal cost. So any cost which has a tendency to vary, to change in direct proportion to the changes in the level of production, that can be called as marginal cost. So my dear students, we have to understand the different aspects of marginal cost. I cannot give you a single line definition that this is your cost of material is your marginal cost. Yes, I can say, but it will actually be like telling you the symptom of a disease. I am only giving you the symptom, and the disease may comprise of various symptoms, the multiple symptoms. So we have to similarly we have to understand that for defining marginal costing or to understand marginal costing, there are different assertions. So first was that it is actually your variable cost. Second is again it is actually stemming from the same definition of variable cost. Because variable cost, another nature of variable cost is it has a tendency to change in direct proportion to the change in the level of production. So if I am increasing my level of production from 10,000 units to say 15,000 and cost of material is 10 rupees, so obviously for 10,000 units it will be 1 lakh rupees, and the moment I am changing it to 15,000 units, it will become 1,50,000. So along with the change in your production, your cost is going to change, or you can say it varies with every change in production. It's not like that you are changing it by 15,000, so it's changing, otherwise it will not. For next 5,000 it will not change. It will change, and the rate of change will remain constant. So this rate of change will remain constant. Why it remains constant? Because we are talking about variable cost, which actually has a tendency to change in direct proportion to the changes in the level of production. At times we are also getting this another definition, another meaning of marginal cost, that whatever cost you are incurring to manufacture one additional unit of a product. So additional cost for manufacturing one additional unit of a product is known as marginal cost. Yes, that also holds true. So in case of extra units which are to be produced, you can say it is actually the cost of producing one extra unit, and that is called marginal cost. So if somebody in my routine class, when some students are giving answer like this, that sir, marginal cost is actually cost of manufacturing one additional unit, they are right. Some of them they are saying that sir, marginal cost means variable cost, they are also right. Somebody says sir, marginal cost is that cost which changes in direct proportion to the change in level of production, they are also right. So all these statements, they are actually indicating about what exactly we mean by the term marginal cost. Now you must be thinking sir is only talking about marginal cost, not marginal revenue. Because my dear students, we have to control our cost and we are here for decision making. So we'll actually focus upon the marginal cost only, and the chapter itself is known as marginal costing. So in marginal costing, we are bound to talk about the cost which is marginal. So marginal cost, this was actually my idea, just to give you a brief layout of what exactly we mean by marginal cost. So these are the statements, these are the assertions from which we draw an inference. We actually try to say that this is called marginal cost. Now the question comes, what additional statements which comes in front of us, what additionally we should know about marginal cost? Yes, we have certain other aspects also. Change in total cost. I said, suppose if your total cost was 1 lakh rupees, and with the change in production your cost became 1,50,000. So if somebody is asking you what is your marginal cost for this lot of production, for this change in production, I would say that this 50,000 rupees is my marginal cost, because it is actually the change in total cost. And the same is the philosophy, the same is the inference which we draw, which we always propagate in the subject of economics also. That while telling you about the marginal cost curve, we say that marginal cost is actually a rate of change in total cost. So it is the only factor which is going to make change into your total cost, and that is why we say marginal cost and variable cost, they are the same. So whether you understand how to draw average variable cost curve or variable cost curve, AVC curve, or you try to understand how to draw marginal cost curve, in one way or the other, they both of them, they are going to represent the rate of change in your total cost. So that we have to understand that it is actually a rate of change in total cost. Cost of producing one additional unit. I am just summing it up. Cost of producing one additional unit is also known as marginal cost. So whether you go by TRTC approach or you go by MRMC approach, that is marginal revenue and marginal cost approach, or total revenue total cost approach, if you talk about marginal revenue, then obviously rate of change in your total revenue can be termed as marginal revenue. And the same is the philosophy for marginal cost. The rate of change in your total cost is going to be called as marginal cost. And if I go by marginal revenue, marginal cost approach, obviously there is no doubt, because I'm from the very beginning, ab initio, I'm only taking the marginal cost, I'm only taking the marginal revenue. So there is no doubt into that, whether you take marginal revenue or you take marginal cost. So there is no change into that, right? So after these assertions, I hope that you must have understood what exactly we mean by the term marginal cost. So by now you are in a position to understand what exactly we mean by marginal cost. And once you have understood the meaning of the term marginal cost, it's my duty to tell you what exactly is the definition for marginal cost. And we have a very reputed kind of institution called CIMA. CIMA London, their definition is a kind of established definition for management in the field of management accounting. So what they are talking about marginal cost, what they say about marginal cost, that we should know. They are saying that the accounting system in which variable costs are charged to cost units, variable costs are charged to cost units, and fixed cost of the period are written off in full, in totality, against the aggregate contribution. And further they are stating that its special value is in decision making. They are saying that whatever is the definition of marginal cost, their special relevance, they are very much relevant for decision making. And that makes this concept so relevant that everybody is trying to understand what exactly is marginal cost, the way we have to interpret it. So let us break this definition into three statements. So it is talking about the accounting system. It is talking about establishment of a kind of system where you can take some data, take some input from it, from this system for your decision making. Here what we are, the kind of system we are developing, what is our expectation from the system? Our expectation, or you can say our modus operandi to deal with this system, is that we are going to classify our cost into two segments. One is variable cost, another is fixed cost. Variable cost, they are charged to cost units. So suppose if you are producing 10,000 units, they are being charged to those units. If you are changing your production, level of production, accordingly there is a change into your variable cost. That is why we say variable cost per unit is constant, but in total it actually changes. So with every change in production, your total variable cost is bound to change. But if you calculate the rate of change, that remains the same. Cost of material is 10 rupees, say for instance, that will remain constant whether you produce 10,000 units or you produce 1 lakh units in a given setup, unless there is a change in there is a correction or revision in the market price. We assume that there is no change into variable cost per unit. So your cost of labor is fixed. If you are hiring a labor for 1 hour, the charge is suppose 100 rupees. For 8 hours, it is going to be 800. So your total is changing, but the rate of payment to that worker, to that laborer, remains the same. That is 100 rupees per hour. So in accordance with the change in number of hours, your total variable cost is changing, but your per unit cost for that labor remains constant. That is why we are saying variable costs, they are charged to cost units. And the second part of the definition is very much relevant for us. It is saying that when we talk about the fixed cost of the period, they are written off in full. You are writing off the entire fixed cost in totality against the aggregate contribution. So whatever contribution you are getting, and I'll be telling you in due course of my lecture what exactly we mean by contribution. But here, for your understanding, I am just giving you a small single line definition for contribution. Contribution is actually the sum total of fixed cost and profit. It is basically the value which is with us to survive. After saying that our variable costs are now retrieved, after that this much is available with us, which will actually first go for writing off the fixed cost, and if afterwards, if something is in residue, something is in balance, that will be regarded as profit. Else you would end up saying that we have actually incurred loss into this production process. So fixed cost of the period is supposed to be written off in totality, in full. You have to write off the entire amount of fixed cost against the aggregate contribution. Then only you will be in a position to say that whether you have made profit or you have incurred loss. And lastly, they are saying in this process of segregating your cost into two segments, one is the fixed cost, another is variable cost, you are saying that your special value is in decision making. You are going to make a decision that whether I should continue our production or I should stop, whether I should make or I should buy, whether I should shut down or I should continue. Suppose if I have received a special order from abroad and I have to quote a minimum price, or I have received an order for a given price, whether I should accept it or not. So all these series of decisions you can take from this marginal costing statements. Once you have prepared that statement, you can actually take n number of decisions when it comes to your variable cost. Because it is actually the variable cost about which you are worried in short run. You are actually worried about retrieving your variable cost in short run. You just want to retrieve, because you cannot survive unless you retrieve your entire variable cost. Every factory says that fixed cost we can wait for good time to come, for long run to come, that in long run we shall be in a position to retrieve. But for variable cost we need that money back. I cannot pay the amount of material, cost of material or cost of laborer from my own pocket. That is something which I need to charge from my customers. So I would say that variable cost is actually the front line cost which we are willing to retrieve in any case. It is actually a question, it will actually raise a question of survival in front of us. So we need to understand that variable cost is something which is going to decide whether you will shut down or you will continue. If you are able to retrieve your variable cost in short run, this technique says that yes, you should continue, you should not shut down. But suppose if you are preparing your while crafting your statement, while preparing your statement, you came to know that we are not able to retrieve the variable cost. I'm sorry to say that we have to take a tough decision of shutting down the business. So these are the important points, cause of which the CIMA London says that this technique has a special value in decision making process. So with this, I hope you must have understood what exactly we mean by the term marginal costing, the way it has been defined. Now the question comes, what are the assumptions in marginal costing? Likewise, other theories of economics, in marginal costing we have certain assumptions. Now these assumptions we have to make, cause if these assumptions are fulfilled, then only you can apply this marginal costing. First is, all cost, they can be segregated into fixed and variable cost. So this is the first and the foremost assumption of this technique. If you are somehow not able to segregate your cost into two segments, what is fixed cost and what is variable cost, we cannot apply this technique of marginal costing. So in order to be able to apply this technique of marginal costing into our decision making process, we should be in a position to understand that we should be in a position to classify our cost into fixed and variable cost. So if you are not able to segregate your cost into fixed and variable, you cannot apply this technique. So in order to be able to apply this technique, the first condition is that you should classify your cost into fixed and variable. Second is, your selling price per unit should be constant. It is constant, this is the another assumption. Third is, variable cost per unit is constant. Honestly speaking, these three are the most important and the only assumption which you have to keep in mind while preparing your marginal cost statement. And total fixed cost is also constant. Remember, the fixed cost in total, it should be constant. So these are the assumptions of marginal costing with which you will have to actually take your decision. Now I'll briefly tell you about marginal costing statement, what we do into that statement. We actually have to show the sales first, then we deduct variable cost out of it, and resultant value is known as contribution. Contribution is, as I told you, it contributes towards two components, one is the fixed cost, another is profit. So after retrieving fixed cost from contribution, that is deducting it from contribution, remaining value is known as profit. And if there is some interest, we deduct interest out of it, and then the value becomes EBT. But as far as marginal costing is concerned, the relevant value for us is profit, that is contribution minus fixed cost. So with this, I hope you must have understood the basic of marginal costing. You must have clarified, this lecture must have clarified you about the meaning and definition of marginal costing along with the assumptions. We'll again in this series we'll talk about the numerical problems, the way we have to apply this technique in the next lecture. Thank you so much.